Welcome to the Deep Dive, where we sift through the noise, look at earnings calls, company reports, all that good stuff, and pull out what really matters. We want to give you the core insights, help you get up to speed quickly. Today, we're digging into Karooooo's Q1 for their fiscal year 2026. We've got the earnings call transcript, some market context, basically trying to piece together the full picture.
Exactly, because earnings calls, they're more than just numbers, right? It's management laying out their thinking, their strategy, the hurdles they see. It's a direct view into the company's health. So yeah, our goal is to boil this down for you. What did Karooooo do well? What's their plan? And what does it maybe signal for the future?
Okay, so first off, for anyone maybe not super familiar, what is Karooooo? They run this SaaS platform, software as a service, right, for connected vehicles, mobile assets, think trucks, equipment, that sort of thing. It helps businesses run smoother, cut costs, boost safety, stay compliant, basically smarter decisions for physical operations.
Right. And the context here is key. They're in a big market, lots of potential still, not fully tapped. And you've got these big trends pushing demand digital transformation. Everyone wants efficiency. Safety's huge, compliance. Plus, Karooooo has this sort of founder business feel. You often see that translating to, strong financials, very careful about how they spend money, disciplined capital allocation is kind of their thing.
And that discipline shows up in the numbers, right? You mentioned their model, attractive growth, high margin subscriptions. What was it, 98% of their revenue?
Yeah, 98% subscription. That's huge.
Yeah.
It makes the revenue very predictable. Plus, they have really strong commercial ARR retention, 95%. Customers stick around.
And those unit economics, LTV to CAC above 9 times. That sounds impressive.
It really is. Lifetime value to customer acquisition cost.
Yeah.
So for every bit of money they spend getting a customer, they expect to make back 9 times that over the customer's lifespan. That's a very healthy engine, shows the customers see real value.
And they're not just in one place. They've got, over 2.4 million subscribers?
2.4 million subs across more than 125,000 businesses.
South Africa, Southeast Asia, Europe. Diverse industries too, logistics, mining, agriculture, construction, retail, public sector.
That diversity helps, makes them less reliant on any single sector or region. It speaks to a broad need for what they offer.
Okay, let's hit those Q1 highlights then. This is where it starts to get interesting. Total revenue is 1.277 million South African Rand, or ZAR. That's up 18% year over year.
And importantly, that core subscription revenue also up 18% to 1.141 million ZAR. Consistent growth there.
EPS, earnings per share, 8.55 ZAR, up 19%.
Good bottom line growth too.
Total subscribers, like you said, about 2.4 million now. That's up 17%.
And ARR, annual recurring revenue, hit 4.574 million ZAR, up 18%. But measured in US dollars, that ARR growth was actually 24%.
24% in USD terms. That's quite an acceleration.
It is. Shows strong momentum, especially when you factor in currency effects. It suggests the underlying growth is maybe even stronger than the headline ZAR number shows.
And you mentioned something about the rule of 60. Usually you hear about the rule of 40 for SaaS.
Right. Rule of 40 is considered top tier, revenue growth rate plus profit margin. Karooooo, specifically their main Kartra segment, hit 65%. That's combining Kartra's 19% subscription revenue growth with its 46% adjusted EBITDA margin.
Wow, 65%. What does that practically mean?
It means they're in rare company, especially for a smaller public SaaS business. They're growing fast and they're highly profitable. They're not sacrificing one for the other. It suggests a really efficient, well-oiled machine. They've found that sweet spot between investing for growth and generating profit. Give them options.
Options are good. So they're investing, but margins are holding up. Any risks there, like if competition heats up or expansion costs rise?
Always a risk, yeah. But that rule of 60 suggests a strong foundation. They seem very deliberate about how they invest. Their track record points to careful capital allocation, not just growth at any cost.
Makes sense. Okay, let's break down the segments. Starting with Kartra, that's the core platform, right? The main growth engine.
Exactly. Kartra did 1.1 billion ZRR in subscription revenue in Q1, up 19%. And management noted that growth is accelerating everywhere. What's really striking is the operating profit margin stayed stable at 30%, even while they're pumping more money into sales capacity. That points to real efficiency.
Yeah, 30% margin while growing sales investment is strong. And they added a record number of subscribers in Q1, 84,000.
84,000 net adds, up 11%. And again, LTV to CAC over 9 times, 95% commercial ARR retention. Those fundamentals look rock solid.
Just solid SaaS metrics across the board there.
Definitely. Then you have Karooooo Logistics. This is their delivery as a service piece. Growing fast, more strategic maybe, helps keep large enterprise customers happy, especially in e-commerce and logistics. It's a capital light model for them.
Right, helps with retention, gives them insights into customer operations. So Karooooo Logistics revenue hit 121 million ZR, up 20%, or 26% in USD.
Yep, strong growth there too. Operating profit margin was 8%, lower than Cartrip, but strategic.
Why the lower margin? Is that just the nature of the logistics business?
Partly, yes, but it's also about the bigger picture. Karooooo Logistics makes the whole KARO offering stickier for those big clients. It solves a key pain point last-mile delivery. So even if the margin's lower, it helps retain high-value Kartra customers and gives KARO data to improve the main platform. Think of it as ecosystem building. Long-term value over immediate margin in this bit.
Okay, that ecosystem play makes sense. Let's look geographically. South Africa is still the biggest piece of the pie.
By far. About 1.8 million subscribers, 70% of subscription revenue, and growth accelerated there to 16%. Management says both commercial and consumer sides are doing well.
And the focus there is cross-selling. Video, Kartra tag.
Exactly. They want to deepen their hold. Now, there's a little nuance here. The video and bundle tags are helping extend future revenue commitments, their RPO, but they're also selling a lot of standalone Kartra tags. These bring in less revenue per subscriber initially.
Ah, so that might dilute the average revenue per user, the ARPU, a bit.
Potentially, yes. It means the overall ARPU uplift from cross-selling isn't as high as it might be otherwise, and it could slightly delay hitting a specific 10% RPO growth target they mentioned for FY26.
Is that a worry, selling lower price tags that dilute ARPU?
Not really a worry, more like a strategic choice, you know. It's classic land and expand. Get the tag in the vehicle first, wider reach, bigger footprint. Then, once you have that relationship, you can sell them the higher value stuff later. So it might slow the ARPU metric a bit now, but it builds a much bigger base for future growth. Long-term play.
Got it. Building the foundation first. Okay, Southeast Asia and the Middle East, mostly SEA, right? That's the big growth story.
Absolutely. Subscriber growth there accelerated to 22%. They've got about 290,000 subs, making up 17% of total subscription revenue now. And revenue growth accelerated even faster, up 30%. Management called it their fastest growing region, biggest long-term opportunity.
And they're backing that up with investment, a big increase in salespeople.
A huge increase, planning a 70% jump in sales headcount there by February 2026.
70%, wow.
Yeah, it signals massive confidence. They think the growth is coming from just expanding their reach, getting into the market more aggressively. They mentioned they aren't really seeing tariff impacts yet, but, you know, keeping an eye on it.
That kind of hiring spree, 70%, what's the risk? Can they onboard and train people that fast without losing productivity?
That's the key question, isn't it? There's always execution risk with rapid scaling, but management seems to believe the market demand is strong enough and their processes are good enough to absorb that growth and get those new hires productive. It's a calculated bet on scale.
Okay, and Europe? Smaller, but still growing well.
Yep, about 210,000 subscribers, up 20%. It's about 10% of subscription revenue. And revenue growth accelerated there too, 22%, or 20% if you strip out currency effects.
And partnerships with OEMs, car manufacturers, are key there, plus compliance tech.
Right. Those OEM deals could make it easier for businesses to use KARO data directly from newer vehicles. And compliance is a massive driver in Europe, so having good tech for that is a real advantage.
Okay, so stepping back, what are the big strategic priorities for this fiscal year, FY26?
Pretty clear, really. 1, keep dominating in South Africa, especially with cross-selling. 2, push hard on expansion in Asia and Europe. 3, get customers using more of the platform, especially things like their AI video solutions.
And underpinning all that is this disciplined capital allocation philosophy you mentioned.
It seems baked into their DNA. 20 years of profitable growth, careful spending. Priority 1 is organic growth, investing in the core business and new products because the returns look good.
Right. That high LTV to CAC justifies it.
Exactly. Priority 2 is returning extra cash to shareholders, mostly through a dividend, but they were clear. Growth investments come first.
And M&A, mergers and acquisitions.
Third priority, and they sound very cautious, high bar. Only if it clearly makes strategic sense, like speeding up product development or entering a market faster, not just buying revenue.
Interesting. And they did that hypothetical no growth analysis. What was that about?
Yeah, that was fascinating. They basically said, look, if we hypothetically stopped investing so heavily in sales and marketing and just focused on keeping our current customers, which they do very well, our operating profit margins could jump from around 30% now to maybe 38%.
Wow. So that shows how much they're currently choosing to reinvest in growth.
Those upfront customer acquisition costs hit the books immediately,
Right.
even though the revenue comes in over years. So that analysis highlights the underlying profitability that's already there. They have flexibility. If they want to maximize margins over growth, they could.
That's a powerful position to be in. Okay, let's quickly touch on the Q&A nuggets. Anything jump out?
A few things. In South Africa, they expect the good subscriber growth, commercial and consumer, to just keep going this year.
Okay, steady as she goes there.
Southeast Asia growth, they reiterated, is about footprint and market share gains. Not seeing tariff issues for now.
The cross-selling impact, video and tags. They saw a 2% lift to future revenue bookings, RPO, in Q1. Hope for more by Q4. But the goal isn't really boosting retention higher.
Right, it's already at 95%. The goal is maintaining that high retention by adding more value, making the platform stickier, reduce churn risk, increase lifetime value.
That 70% sales staff increase in Asia. They think, ideally, that could lead to maybe 28% subscriber growth there this year. Ambitious.
Very, but shows their target. They also talked about data collecting over 220 billion data points a month. That feeds innovation, makes the platform smarter. It's a compounding advantage, a data moat.
Right. The more data, the better the insights. What about Karooooo logistics ownership?
They have an option to increase their stake in February 2026, something they'll evaluate then and going forward, a key decision point on the horizon.
And the Kartra tag and SA sounds like it's going really well.
Yeah, they use terms like phenomenal progress, game changer. Still early days, but lots of traction.
And lastly, their tax rate is getting a boost from using past losses as some entities turn profitable.
Yep, a nice little tailwind on the net income line.
Okay, so wrapping this deep dive up, Karoooo's Q1 looks pretty darn strong, accelerating growth, especially in Kartra and Southeast Asia, and they're managing that classic balancing act, investing heavily in growth while keeping margins healthy and those unit economics looking powerful.
Yeah, it really highlights a proven, profitable SaaS model firing on, well, maybe not all cylinders yet, but quite a few. Consistent execution, sticky revenue, big market, disciplined spending. This kind of dive shows you how a company like Karooooo tries to thread that needle, grab market opportunities, invest smartly, stay financially strong, and actually solve real problems for businesses.
And just a reminder for everyone listening, nothing we talk about here is financial advice. We're just trying to break down the information from the source, in this case, the earnings call, to help you understand the market and form your own views.
So here's a final thought. Karooooo talks openly about that rule of 60 and even games out a no-growth scenario with much higher margins. It makes you think, doesn't it? In today's market, where everyone wants both growth and profit, how do you personally weigh those heavy investments for future growth against the potential for higher profits now if they slow down? What does that say about the real underlying value of those sticky high LTV customers they have, even separate from the headline growth rate? Something to chew on.